So let's move on with GOPPAR. Despite the popularity of RevPAR among many RMs, more sophisticated RMs and the majority of hotel GMs daw po, they prepare to monitor or track their property GOPAR achievement because alam po nila na excessive RevPAR focus can actually harm a hotel's long-term profitability. This is especially daw po in times of severe weakness in rooms demand. In Chapter 1, we learned that GOPAR represents a hotel's gross operating profit per available room. GOPAR is the average gross operating profit or yung GOP generated by each available guest room during a specific accounting period. So gross operating profit is total revenue less management less controllable operating expenses, and GOP can be expressed daw po in dollars or as a percentage of total revenue. So a close examination of the GOPAR formula shown in figure 9.2 reveals 3 significant reasons for its appeal to hotel GMs and owners. So the first one po is ang statistics is calculated daw po using total, not rooms only, hotel revenue. This is an especially and critical factor in full service hotel. Number 2, a GOPAR calculation includes expenses as well as revenue but focuses only on those expenses that can be controlled by on-site hotel managers and for which these managers can be held accountable. So let's take note daw po that the GOP is the numerator in the GOPAR. Number 3, yung calculation daw po is based on the total number of available rooms in the property as RevPAR, and thus is avoid the limitation of those statistics such as RevPAR that are determined by the number of sold rooms only. So, ito po yung figure 9.2 GOPAR formula. Total revenue less management less controllable expense over rooms available to sell. So, as we can see po dito sa figure 9.3, tingnan po natin dito is yung nasa gitna, higher ADR, lower occupancy. And, hindi pala. Tingin po muna tayo dito sa pare-parehas nilang RevPAR, which is magkakaparehas po. Even though po magkakaparehas sila ng RevPAR, nagkakaiba-iba naman po sila ng GOPAR. So, tingnan po natin dito sa gitna, higher ADR, lower occupancy. So, makikita po natin yung $114.99 na ililes po natin dito sa higher occupancy, lower ADR na GOPAR, which is the $99.99 dollars. At makakagain po siya ng 15% na mas mataas po sa nag-gain po ng higher occupancy, lower ADR na $99.99 na ililes naman po natin sa moderate ADR or moderate occupancy na 107. Tas ang lalabas naman po dito is 7%. So yun, kahit nga po magkakapare sila ng RevPAR, nagkakaiba-iba po sila ng GOPAR. So, because the number used in its calculation, a GOPAR maximization strategy is more sophisticated than a RevPAR maximization strategy. So, the influence of GOPAR assessment on RM's pricing and selling strategies should be clear. Consider, for example, that a strategy of selling rooms below the combined total occupancy cost and selling costs should be avoided because implementing such strategy would lead to decrease in GOPAR. Although such strategy would increase occupancy percent, total room revenues, and the resulting RevPAR. Similarly, if a hotel decided to temporarily increase sales commission to encourage room sales, this would be reflected in a reduced GOPAR but not reduced in RevPAR. A GOPAR focus is to eliminate some of the negative inherent in an undue focus on RevPAR. Because a hotel's operating profit is divided by the number of available room nights, GOPAR will increase as long as each incremental unit sale, whether rooms, F&B, or other revenue, generates profit. So, experienced RMs know that GOPAR focus may also help to resolve the traditional conflict those in hotel operation. Example po is the housekeeping and F&B staff and properties sales team. Because this conflict often arises because of the operation staffs focus only on departmental cost and profitability, while sales staffs typically concentrate on increasing total revenue regardless of costs. This is especially so when sales staff salaries, bonuses, and other incentives are based on RevPAR generation. And it is important to note that cross-property assessments of GOPAR must be made carefully. To illustrate, consider two hotels, each of which offers 400 rooms for sale. Assume further that the amount of meeting space, F&B capacity in Hotel A greatly exceeds that available in Hotel B. In such a case, it is very possible that its extra capacity results in the GOPAR Hotel A exceeding that of Hotel B. This could be true. However, even if Hotel B does a better job of selling its available space profitably. It is for this reason that RMs working in full-service hotel must carefully consider the impact of meeting space and F&B sales and resulting profits on their hotel's overall profitability. So let's move on with this scenario, which is the RM at work 9.1. Run the numbers, said Elijah, the FOM at the 400-room Radisson Riverview. We need to make sure we are accurate about this. I ran them 3 times already, replied Jennifer. Last year in September, our RevPAR was $87.50. We ran a 70% occupancy and a $125 rate. And so far this September, asked Elijah, like I said before, 3 days left in the month, we are at 69% occupancy and $129 rate. That's on $89.01 RevPAR, said Jennifer. And we were budgeted for a 4% RevPAR increase, asked Elijah. Right. And that's the problem. We are at 1.5% increase now. And as so you know, if we don't make budget, we don't make our bonus. Okay, I got it. Now one more time. What did the New York booking agent say when you talked to him on the phone? Asked Elijah. He said the entire Lion King cast was displaced because of a booking error at the hotel they had reserved. He's scrambling for housing. He wants to bring the entire cast and crew here for 4 days, starting tonight. They want 100 rooms each day, but their budget is only $59 at a night. If we take them, will be sold for the rest of the month, said Jennifer. Assume that with 3 days left in the month, Elijah's best estimate is that if he agrees to the Lion King group, it would mean 100 sold rooms per night at $59 rate. And assume that further that his hotel would indeed sell all of its remaining rooms on those nights at the 129 ADR property is currently averaging for the month. So if it takes the group, number we have here the question 1. If he takes the group, would Elijah achieve the RevPAR needed to be granted the performance bonuses offered to him and his assistant? Question number 2. What additional factors would you advise Elijah to consider before he decides whether to accept the reservation for the rooms requested by Lion King's booking agent? Number 3. If you were the RM at this property, would you advise Elijah to take the group? Why or why not? Flow through. So, flow through is an accounting concept that may not be immediately recognizable as a significant revenue management issue. It is, however, extremely helpful in understanding the effect of revenue optimization strategies employed by a revenue management team. So, flow through deploy is a measure of ability of hotel convert increased dollars to increase gross opening profit dollars. Understanding the flow-through concept is critical, yet U.S. hoteliers have been somewhat slower than their European counterparts in measuring and reporting flow-through. So this is readily demonstrated in the financial report of companies such as Accor, the French hotel group. So note in the emphasis on flow-through given by Accor in this portion of financial report on a profit performance in its various international hotel groups. As a result, earnings before interest, taxes, depreciation, amortization, and rent or EBITDA margin in Europe was up to 0.03 points with a flow-through rate of 49%. In Latin America naman po, the EBITDA margin improved by 2.0 points and the flow-through reached 64%, 77. So note both the emphasis on flow-through as well as its degree of variation within differing hotels. Increase or decrease daw po ng flow-through rates carry significant amounts of information directly to the performance of an RM team. As a result, it is likely your own revenue optimization performance will be assessed in part via calculation of flow-through rates. Because that it is so, you should understand the concept well and recognize the revenue management related actions that will increase or decrease your own properties flow-through. To better understand flow-through, consider the January operating performance of the 240-room Splashdown Water Park Resort. Figure 9.4 details the property's monthly operating performance last year and this year. Using data from figure 9.4, the Splashdown's flow through for this January can be calculated by applying the following flow through formula in this example. The calculation would be so ito po yung flow through formula, which is GOP this year minus GOP last year over total revenues this year minus total revenues last year. So, ito po yung ating given, 627,990 less 19,940. Ang total po nito is 108,050 and 2,100,150 less 1,952,580 is equals to 147,300, and it is equals to 73.4% flow through. So ito po yung ating Splashdown Water Park Resort income statements. So because gross operating profit or GOP is calculated as total hotel revenue less those expenses that are considered directly controllable by management, flow-through was created by managerial accountants to measure the ability of a hotel covered increases in revenue directly increases in GOP. In this example, 73.4% of incremental revenue of 73.4 cents of every additional revenue dollar has been converted to gross operating profits. For most hotels, incremental revenue increase return disproportionately high profit levels because variable costs, see Chapter 2, are so low. If rooms are sold at too low rates, however, flow-through will be reduced despite the sales positive impact on RevPAR. Note that the Splashdown property an increase in revenue of only 7.5%, 2,100,150 and 1,952,850 yes 1,952,850 is equals to 7.5% over the prior year, resulted in gross operating profit increases of 20.8%, 627,990 less 519,940 and 519,940 is equals to 20.8% because of that additional revenue. Flow-through is computed to help managers identify the impact of increases in revenue on profitability. When it is high, typically over 50%, it reflects in converting as additional revenues and additional profits. For most hotels, flow-throughs that are less than 50% indicate relative inefficiency in converting additional revenues into additional profits. In most cases, increased revenues that yield low flow-through rates indicate the revenues generated were not of sufficient quality to enhance profit. This would be the case, for example, when an effort to enhance RevPAR, an RM team sells additional rooms at rates too low to significantly improve profit levels. This reinforces the point first made in Chapter 6 and examined again in Chapter 13 that not all revenue is created equal. Some revenue is good revenue and some revenue is simply not as good. Reduced flow-through rates can also be the result of disproportionately high operating costs directly related to increases in revenues. To illustrate, consider the sales department of hotel that creates a room package including many amenities, roses, roses, chocolates, and wines for Valentine's Day special dinner and overstay. If, in this case, the number of incremental revenue dollars achieved from the sales effort are only modestly higher than the cost of the room and amenities provided, the hotel's RevPAR would increase but would be offset by a very low flow through rate resulting from the high cost of generating of modest increase in incremental revenue.